Let me ask you something. How many of you have worked your whole life, built equity, paid off your home, but still feel like your money isn't really working for you? I had a client tell me recently, Jennifer, I have a beautiful home, but I don't feel like I have income. And that's when I realized this isn't a money problem, it's a strategy problem. And today I'm going to show you a different way to think about it. First, I just want to say thank you for being here because I always say when we gather like this, especially as a Filipino community, we it's not just about business, it's about helping each other, sharing knowledge and supporting one another's future. And that's something I take very seriously. For those who haven't met me yet, my name is Jenny. I was born and raised in the Philippines. I moved here to the United States in 2018 and now currently residing in Las Vegas. Like so many of you, I came here with a vision to grow, to create opportunities, and to build something meaningful. And through my journey in real estate here in the US, especially in Las Vegas, I started to see something very clearly. There are so many opportunities available, but not everyone has access to the right guidance, the right strategy, or the right connections. And that's exactly why I created Your Global Connection. Our mission is simple: to connect people to wealth, wisdom, and world class opportunities, not just locally, but globally, especially between the US and the Philippines. And before we dive in, I also want to take a moment to acknowledge all of our sponsors and our partners because events like this don't just happen alone. It takes people who believe in this vision, people who are committed to education, to collaboration, and to creating real opportunities for our community. So, to all of our sponsors and our partners, thank you so much for your support, your trust, and for being part of this movement. Now, today, this session is a little different. This session is not about what to buy, it's about how to decide if something is actually worth buying. Because at this stage in life, it's no longer about taking chances, it's more about making smart, confident decisions with what you've already worked so hard to build. And that's exactly what we're going to walk through today. So let me share something I see very often. And I want you to really listen to this, not just as information, but as something that you might recognize in your journey. Most investors, even very smart, hardworking, successful people, make decisions based on three things. And first, they follow what other people are doing. And I get it. When you see your friend buying, your coworker investing, or someone posting online about their property, it creates this feeling like, I should be doing something too. But here's the problem: you're not seeing their full situation. You don't know their financial position, their timeline, their risk tolerance, or even their real results. You're only seeing the highlight. And when you make decisions based on someone else's strategy without understanding your own, you're no longer investing, you're reacting. Second, they focus too much on price. This is probably the most common one. People ask, is it cheap? Is it a good deal? Can I get a discount? But here's the truth: cheap does not mean valuable. And some of the most expensive mistakes come from buying something that looked affordable but had no real demand behind it. Because real estate is not just about price, it's about demand, location quality, connectivity, and long term usability. If you only focus on price, you miss the bigger picture. And third, and this is a big one, they enter too late. They wait until everyone is talking about it. They wait until the project is popular, the area is already developed, and the prices have already moved. And then they say, Now, okay, now I feel confident. But by then, you're no longer early. You're paying premium for certainty. And the biggest gain in real estate is usually happening when the story is not obvious yet, when infrastructure is still developing, and when demand is just starting to form. But that phase feels uncomfortable because it requires clarity, understanding, and strategy. And I've had so many conversations with investors who tell me, hey, Jenny, I wish I knew this earlier, not because they weren't capable, not because they didn't have the money, but because they didn't have a framework. And this is the truth I want you to take today is the biggest mistake in real estate is not the market. It's not even the Philippines. It's not the developers. It's not the timing. It's not having a clear way to evaluate your decisions, because when you do not have a framework, every opportunity looks very confusing. You don't know, is it good, is or is this just marketed well, is this early or already too late, is this investment right for me, or it's just popular. When you have a system, everything changes. You stop guessing, you stop reacting, and you start evaluating. And that's exactly why we created the framework you're going to learn today. Because by the end of this session, I don't want you to feel inspired. I want you to walk away with clarity, because once you have that, you don't follow the opportunities, you recognize them. And that's where we introduce the systems that changes everything, and the framework smart investors use. It's the peer model. So today, I want to simply simplify everything for you, because I know when it comes to investing, especially in different markets like the Philippines, it can be very overwhelming. And there's a lot of information, a lot of opinions, a lot of opportunities. And without a system, it's easy to feel stuck, or worse, make the wrong move. So instead of making this complicated, we simplified it into a clear framework. We use something called the PIER model, peer model. Very simple: position, infrastructure, entry strategy, and regulation risk. And I want you to think of this not just as a concept, but as a filter. This is exactly the framework we use before making any investment decision, not sometimes, not when it's convenient, every single time. Because here's the reality: not every opportunity is a good opportunity. Even if it looks good, even if it sounds good, and even if everyone else is doing it. So instead of asking, hey, is this a good deal? We better ask the question, does this pass the PIER test? Does it make sense from a position standpoint? Is there real demand behind it? Is there infrastructure supporting growth? Is accessibility improving? Does entry strategy fit my capital, my timeline, my goals? And is it structured properly under regulation and risk? Am I protected? Right? Because if something doesn't pass this framework, it's a no, not a maybe, not let's try, not it looks okay. It's a clear no. And I want you to realize, I want you to really understand the power of that, because most investors, they lose money not because there were no opportunities, there were no good opportunities, but because they said yes to the wrong ones. This framework gives you permission to say no with confidence. And that's how you protect what you've worked so hard to build. Because investing is not just about making money, It's about keeping it, growing it, and doing it strategically. And over the next part of this session, I'm going to break down each part of the PIER model for you so you can start thinking like a strategic investor and not a reactive one. All right, so let's start with the first and most important pillar, position. And I want you to really anchor this idea. Where you invest matters more than what you buy. Because this is where people get confused. They look at the property, they look at the finishes, the designs, the amenities, the price, the promotions, and all those things feel important, but here's the truth. Those are surface level. They're really surface level details. The real question is not about property. The real question is there a demand in this location? Because you can have a beautiful unit in a bad location and it will struggle. But you can also have, on the other hand, you can have a simple unit in a high demand area and it will perform. That's the difference. Because real estate is not about how nice something looks, it's about how usable it is to real people. And demand is what drives everything. Demand drives who rents the property, how quickly it gets occupied, and how much you can charge, and how easily you can sell later. So instead of asking, do I like this property? You need to start asking, do people need to be here? Because people who don't buy or rent, because, the truth is people don't buy or rent based on the building alone. They buy and rent based on their life. Where do they work? How far is the commute? Is it convenient? Is it connected? Does it make their daily life easier? And that's what really creates demand. And this is where smart investors separate themselves. They don't fall in love with a unit. They don't get distracted by the marketing. They focus on position first. Because once position is strong, everything else becomes easier. The renting becomes easier. The holding becomes easier. The selling becomes easier. But if the position is weak, everything becomes harder. And that's why position is the first filter in the PIER model. Because before anything else, you need to answer one question clearly. Is there real demand here, or is it just good marketing? So now the question becomes, what actually creates the demand? And I want to simplify this for you because once you understand this, you'll start seeing the market very differently. Demand is actually very simple. It comes down to three things: jobs, population movement, and lifestyle. Jobs is where people work, population movement, it's where people are going, lifestyle is where people want to live. So let's break that down. First, jobs. Jobs are the foundation of demand because people need to live close to where they earn. Where there is strong job centers, you will see stronger rental demand, buyer activity, and long-term stability. So, when you're evaluating a location, don't just ask what's being built here. Ask, where are people working? Because jobs pull people. Second, population movement. This is where demand is growing because it's not just about where people are, it's about where people are going. Are people moving into the area? Is the population increasing? Are families choosing to settle here? Because where people move, they create new household, new renters, and new buyers. And that's how demand expands over time. And this is where smart investors get ahead. They don't just look at today, they look at the direction. Third, lifestyle. And this is the part where many investors underestimate. People don't choose based on work. I mean, people don't just choose based on work. They choose based on how they want to live. They want shorter commutes, access to malls, schools, hospitals, walkable environments, safer and more convenient environments. So even if two areas have similar pricing, the one with better lifestyle will usually outperform because people will always pay more for better daily experience. So when you put it all together, jobs tell you where people need to be, population tells you where demand is growing, and lifestyle tells you where people choose to stay. And when all these three are present in one location, that's where you find strong position. And this is the line I want you to remember. People don't rent or buy on the building. They rent and buy based on their life, where they work, how they move, how they live every single day. And once you start thinking like this, you stop chasing properties and you start identifying real opportunities. So, let me give you a very simple way to apply everything that we just talked about. Because at the end of the day, you don't want to overcomplicate this. If you ever feel overwhelmed or unsure about a property, just come back to this simple filter. Before you buy anything, pause and ask yourself these three questions. One, would someone live here? Two, would someone rent here? And three, would someone buy this for me later? And I want you to really think about that, not emotionally, but practically. Not, do I like it? Does it look nice? Is it a good price? But would another human being choose this for their life? Because real estate only works if other people want it too. Let's break it down. Would someone live here? Is it convenient? Is it accessible? Is it near jobs, transport, or daily essentials? Or is it isolated, inconvenient, or difficult to maintain long term? Now, ask yourself, would someone rent here? Is there a real rental demand in this area? Are there people working nearby? Is this a place tenants would actually choose? Because rental demand is not created by property, it's created by the location and the lifestyle around it. Would someone buy this property from me later? And this is the one that people actually forget. Because when you invest, you're not just buying for today, you're buying for your exit. So ask yourself, if I need to sell this, who would my buyer be? Another investor, an end user, a family? And would they see value in this location? Because here's the truth, your next buyer matters just as much as your current decision. If there's no clear next buyer, there is no clear exit. And without an exit, you don't have a complete investment. So if you can clearly say, yes, someone would live here, yes, someone would rent here, and yes, someone would buy this later, then you're likely looking at something with real demand. But if you hesitate, if the question is unclear, if you just have to justify it, then that's your signal. It's not a strong investment. And this is where discipline comes in because not every opportunity deserves a yes. Smart investors don't win by saying yes more often, they win by saying no more strategically. So keep this simple filter with you. Use it every time because when you combine this with position, you stop guessing. You start making decisions with clarity. Now let's move on to the second pillar, the infrastructure. Because if position tells you where demand is forming, infrastructure tells you how that demand grows and how fast it grows. And this is where real estate starts to become very powerful because value is not just created by property, value is created by what's happening around the property. So I want you to remember this simple idea: infrastructure equals value because infrastructure improves three key things: mobility, access, and growth. Let's break that down. First, mobility. How easily can people move? And how fast can they get home, to work, to daily essentials? Because time matters. If you can reduce someone's commute, make their day more efficient, make their life easier, that location becomes more valuable. Second, access. What can people reach from this location? Are there nearby business districts, schools, hospitals, transportation hubs? Because access is what makes a location usable, and usable locations attract more people. Third, growth. What is being built? What is improving? What is developing in the area? When infrastructure is often a signal of future expansion. When you see roads, railways, commercial developments, and public investments, that usually means that the area is expected to grow. Now, when you combine all three, better mobility, stronger access, ongoing growth, you create something very powerful: increased demand. And this is the key connection I want you to understand. When people can move easier, live easier, work easier, more people will choose that location. And when more people choose that location, demand increases. And when demand increases, value follows. But let me add one more important layer here because this is where investors get it wrong. Just because you hear about infrastructure does not automatically mean it's a good investment. You have to ask yourself, is it actually being built? Will people try to use it? And does this price still make sense today? Infrastructure creates opportunity, but only if you enter at the right time and in the right location. So as you move forward, I want you to start thinking differently. Don't just look at the property, look at what's happening around the property. Because the investors who understand infrastructure are the ones who position themselves before the value becomes obvious. And that's where the real advantage is. Now let's bring into a real world concept context, specifically in the Philippines. Because everything we just talked about, position, infrastructure, is already happening in a very clear, powerful way. Right now, we're seeing this through major infrastructure corridors like the Metro Manila subway, the North South commuter railway, and the Clark Growth Corridor. And I want you to understand this clearly. These are not just projects, these are long term shifts in how people live, move, and make decisions. Let's break that down. The Metro Manila subway. It's not just about transportation, it's about reducing travel time, improving daily efficiency, and connecting key parts of the city in a way that was not possible before. So, areas that used to feel far will start to feel accessible. And when accessibility improves, what do you think improves with it? It's demand. Demand follows. The North South Commuter Railway is this is even bigger in scale because now we're not just talking about Metro Manila, we're talking about connecting Metro Manila, Central Luzon, and areas further south. So, what does that do? It expands what people consider as livable distance. People now live farther away, but still stay connected to jobs, to business districts, and opportunities. And when that happens, the entire new areas become viable for real estate demand. Now, let's talk about the Clark Growth Corridor. This is one of the most important long term plays because Clark is not just growing from infrastructure, it's also growing from a combination of transport access, airport expansion. There's also business and industrial activity and government backed development. So, this is not just a single project, this is an ecosystem. And ecosystems create stronger, more sustainable demand. So when you look at these three together, subway, railway, Clark corridor, you're not just looking at developments, you're looking at a shift in how people will live, how they commute, where they choose to live, how far they're willing to travel, and what they prioritize in their daily life. And this is where smart investors think differently. They don't wait until everything is finished. They don't wait until prices have already gone up. They look at these corridors and ask, where will demand move next? Because infrastructure doesn't change locations, it changes behavior. And when behavior changes, that's when markets move. So, as you're evaluating opportunities in the Philippines, I want you to start thinking in terms of corridors and not just properties, because the biggest opportunities are not always in the most obvious places today. They're in the places that are becoming more connected, more accessible, and more livable over time. And that's where infrastructure turns into real value. Now, I know we just talked about a lot subways, railways, corridors, infrastructures. And for some of you, it might feel like, okay, that's a lot to track. So let's simplify this because you don't need to memorize project names. You don't need to know every station, every timeline, every detail. But what you really need is the right question. So instead of trying to remember everything, just ask this: what is making this area easier to live or easier to work in? That's it. Because if something is making life easier, if commute becomes shorter, if access becomes better, if daily routines become more convenient, people will naturally move toward that area. And when people move, demand follows. So let's bring this into real thinking. When you look at a property at a location, ask yourself, is it becoming more connected? Is it becoming accessible? Is it becoming more livable. Not someday, but clearly, realistically. If the answer is clear, and if you can confidently say, yes, this area is improving in a real, usable way, then that's where opportunity begins. But if the answer is a little bit vague, if it's based on hype or future plans, well, and no real progress, then please, you need to pause because opportunity is not built on promises, it's built on real change you can see happening. So remember this: you don't need to be an expert in every single project. You just need to become very good at asking the right questions. What is making this area better for real people right now and moving forward? Because when you can answer that clearly, you're no longer guessing. You're investing with direction, and that's the difference between following the market and getting ahead of it. Now, let me give you one of the most important rules, especially when it comes to infrastructure corridors, because this is where a lot of investors get excited and also where a lot of investors make mistakes. So, here's the rule: don't invest just because you hear about a project, not because it's trending, not because it's being marketed heavily, not because someone told you, "Oh, this is the next best thing." Because announcements and actual opportunity are not the same thing. So instead, I want you to filter every opportunity through this. Invest when three things are true. First, it's actually being built, not just planned, not just approved, not just coming soon. You can see progress. There's real construction, there's real movement, there's real execution. Because until something is physically happening, it's just a story. Second, people will truly use it. Not just, oh, it looks impressive. Ask yourself, does this actually solve a real problem? Will people rely on it daily? Will it make commuting, living, or working easier? Because infrastructure only creates value if it changes real behavior. If people don't use it, it doesn't drive demand. Third, the price still makes sense. And this is where timing comes in. Because sometimes, by the time everyone knows about a project, the prices have already gone really, really up there. And and now you're not early, you're late. So I have to ask, you have to ask yourself as well, am I entering before the value is fully priced in? Or am I paying premium for something that's already obvious? And this is the line I want you to remember: timing matters just as much as location. Because when you can be in the right place, but at the wrong time, and your returns will suffer. So let's bring it all together. Don't invest based on noise. Don't invest based on hype. Only invest when there's real progress, real usability, and the pricing still gives you an advantage. Smart investors don't just find good locations, they enter those locations at the right moment. And that separates opportunity from very expensive mistakes. All right, now let's move to the next pillar: entry strategy. Because even if you get position right, and even if you understand infrastructure, You can still make the wrong move if your strategy does not match you. And this is where a lot of people get stuck. They start comparing themselves with others. They hear, "Oh, my friend bought this pre-selling. Someone made money flipping. This person is buying multiple units." And suddenly they feel like they should be doing the same thing. But here's the truth: not all investments are the same. And more importantly, not all investors are the same. Different people have different capital, timelines, risk tolerance, and goals. So, what works for someone else may not work for you. And this is where people make costly mistakes. They try to copy a strategy without understanding if it actually fits their situation. And when the strategy and the situation don't align, that's when the stress happens. That's when cash flow becomes tight, and when timelines become feel it feels too long. And it's also when people regret their decisions. So instead of asking, what are other people doing, you need to start asking, what is the right strategy for me? Real estate is not about chasing deals. It's about building a strategy that works for your life. And this is the shift I want you to make today. Stop comparing and start aligning. Align your investments with your financial capacity, your timeline, your comfort level, and your long term goals. Because once your strategy is aligned, everything becomes clearer. You stop feeling pressured, you stop second guessing, you stop chasing every opportunity, and instead, you start making decisions with confidence. And that's what entry strategy is really all about. Not just how you enter the market, but how you enter the market in a way that actually works for you. So now let's make entry strategy very simple. Because again, this is where people overcomplicate things. We simplify it into three clear paths: income, growth, and long term. And I want you to think of these not as options, but as strategies based on your intention. First, income. This is where the investors, this is for investors who want steady cash flow, more immediate usability, and a clearer connection to real demand today. You're looking for something that can be rented, occupied, or used relatively soon. So if your focus here is location strength, rental demand, and sustainability. Second, growth. This is for the investor who is focused on appreciation, entering early, and benefiting from future development. This is where pre construction usually comes in. You're buying into a future story, an improving location, a developing corridor. But this also requires patience and a higher tolerance for uncertainty. Because here, you're not just buying property, you're buying time and execution. Third, long term. This is for investors who is thinking beyond short-term returns. This is about legacy, land, holding for future value. You're not in a rush. You're positioning yourself for what this area could become over time. Now, here's the most important part: each of these paths, they're valid. All of these are valid. There's no best strategy. There's there's no one right way, right strategy for you, right? But there's no best strategy. There's only one strategy that's actually perfect for you. And this is where I want you to be honest with yourself. What are your goals? What's your timeline? How much risk are you comfortable with? Because if your strategy doesn't match your situation, even a good investment can feel like a bad experience. So today, instead of chasing what looks exciting, choose the path that aligns with your capacity, your lifestyle, and your long term vision. Because when your strategy is aligned, you don't just invest, you invest with clarity, confidence, and purpose. So now we bring everything together because after understanding position, infrastructure, and different entry strategies, this is where real decisions happen. And I want you to remember this clearly. The real question is not what's the best deal, because there's no universal best deal. The real question is what fits your capital? Can you comfortably afford this without stress? What fits your timeline? Are you looking for something short term, midterm, long term? And what fits your comfort level? How much uncertainty are you willing to handle? How patient can you be? Because here's what most people don't realize: a deal can look great on paper, but feel wrong in real life. If payments are too heavy, if the timeline is too long, if the risk feels uncomfortable, that is not the right deal for you. And this is where most investors go wrong. They choose based on what's popular, what's being marketed right now, and what someone else is buying or is doing. Instead of choosing based on alignment, so I want you to shift your thinking. Don't ask, what is everyone else buying? Instead, ask, what makes sense for me based on where I am today? Because your situation is unique. Your income is different, your goals are different, your responsibilities are different, so your strategy should be different too. And this is where this is a line I want you to take. I want you to take. The right strategy is the one that fits you, not your friend, not your coworker, not what you saw online. You. Because when your investment matches your life, everything becomes easier. You feel confident in your decisions, you stay consistent, you don't panic, you don't you don't second guess. And that's when investing becomes powerful, not just financially, but mentally and emotionally as well. So as you move forward, I want you to anchor into this: clarity over comparison, alignment over hype, strategy over pressure. At the end of the day, this is not about finding the perfect deal. It's about building the right path for your life. And when you do that, you don't just invest. You build something that actually works long term. All right, now let's talk about something very important. And honestly, this is where a lot of investors make costly mistakes: ownership. Before you think about returns, before you think about strategy, you need to be very clear on one thing: what do you actually own? And I want to slow this down because this is not just a technical detail. This is about protecting your investment. So, in the Philippines, here's the reality: foreigners can own condominiums, but there is a condition. Foreign ownership in a condominium project cannot exceed 40% of the total units. So, yes, you can legally own a condo, but it has to fall within that structure. Now, let's talk about land. Land ownership is different. Foreigners generally cannot own land directly in the Philippines. This is where the confusion happens because sometimes people assume, well, if I can buy property, I can own anything, but that's not how it works. This is where understanding structure becomes critical. Depending on your situation, there are different ways people approach this: through Filipino spouses, through corporation, through long-term leases. But if each of these but each of these they have different legal implications. And this is why we always say don't just look at the property, look at how it is owned. You can have a great location, a good strong investment, good potential, but if the ownership is not structured properly, you are exposed. And that's not a risk you want to take, do you? So instead of relying on hearsay, you need to ask, is this ownership legal? Is it properly documented? Is it structured correctly for my situation? Because at the end of the day, real estate is not just about buying, it's about owning correctly. And this is why regulation and risk is a critical part of the peer model. Because we don't just want you investing. We want you investing protected, informed, and structured the right way. Now, this is where everything becomes real. Because once you understand ownership, the next layer is just as important: structure. And I want you to hear this clearly. Structure is what protects your investment, not the brochure, not the marketing, not even the location alone. It's the structure behind the deal. So when we talk about structure, we're talking about three key areas: legal structure, the banking process, and the documentation. So let's break this down. First, legal structure. Is the property properly titled? Is the developer compliant? Very, very important. Is the ownership set up correctly based on your situation? Because if the legal foundation is weak, everything else becomes a risk. Second, banking process. How is the transaction being handled? Are you paying cash? Are you using financing? Are funds being transferred properly? That's the very important thing. And this is where strategy comes in because there are multiple ways to acquire investment in the Philippines depending on your position. For example, you can leverage a HELOC program, it's home equity line of credit, through a local US lender, your loan officer, allowing you to use your existing equity here to invest abroad. Or you can utilize programs like the OPHL, or Own a Philippine Home Loan program, through the Philippine National Bank, which allows US based buyers to finance Philippine property in US dollars. helping reducing currency risk and simplifying the process. And those are just two options. There are other strategies available depending on your income, your assets, your goals, and your long term vision, which is why there really isn't a one size fits all approach to this. Third, documentation. Do you have complete and verified documents, contracts, ownership records, developer approvals? Because if it's not properly documented, it's not fully protected. And this is where I want you to shift your mindset. These are not small details. These are not the things to figure out later. This is the deal. Because you can have a great location, a strong demand, a beautiful project, but if the structure is weak, your investment is exposed. So instead of rushing into opportunities, slow down and ask yourself, is this structured correctly? Is it verified? Is everything verified? Am I protected from the very start? Number three, because smart investors don't just look for upside. They build a strong foundation first. And when your structure is solid, you don't just invest. You invest with security, confidence, and control. Now, here's your next step. If you're serious about exploring opportunities in the Philippines, we are offering a complimentary strategy call where we will walk you through your specific situation and map out the best investment approach for you, specifically for you, whether it's leveraging equity, using international financing, or structuring your purchase the right way. Will help you get a clear, confident, and aligned before you make a move. So feel free to schedule a strategy call with us, and let's build this the right way from the very start. All right, let's get into the details. Let's start with one of the most powerful strategies available to US based investors, and that's leveraging your existing equity. A HELOC program, home equity line of credit, allows you to borrow against the value of your property here in the US. And what smart investors do is that they take that equity and reposition it into another asset. In this case, the real estate is in the Philippines. So instead of waiting years to save cash, you're activating what you already have. Now, here's why this is powerful. When you use HELOC, you're typically entering the market, the Philippine market, as a cash buyer. And that changes everything. You can move faster, you can negotiate better, and in many cases, you can secure better pricing or incentives from developers. Remember, cash is king. It also gives you flexibility. You can use those funds across multiple investments, not just one. Let's be real. This is not risk-free. Because you are leveraging your US property, if something doesn't go as planned, your asset here is still tied up to that decision. And on top of that, HELOC usually comes with variable rates. So your payments can change over time. And this is why this strategy is best for investors who understand leverage, have strong equity positions, and want speed and control in their investments. So if you're someone who wants to move fast, play the game from a position of strength, This is one of the most effective tools available to you. Now, let's talk about another powerful option. And this one is designed specifically for international buyers, the OPHL program. It's Own a Philippine Home Loan through PNB, or Philippine National Bank. So, this program allows you, as a US based buyer, to finance property in the Philippines without needing to go through the traditional local banking system there on your own. And here's what makes this unique: the loan is often structured in US dollars, which means you're not dealing with constant currency fluctuations, and you're not navigating complicated remittance processes every time you make a payment. Everything is more streamlined, more familiar, and more controlled. And this is ideal for buyers who do not want to leverage their US property, prefers a structured financing route, or simply want a more guided, compliant process. And depending on the property, you may be able to finance up to around 70 to 80%. But let's also be honest about the trade offs. This process is typically slower. There's more documentation involved, more income verification, tax return approvals. And if you're a foreign national, you're generally limited to the condominium ownership. Also, interest rates can sometimes be higher compared to what you might access here in the US. So, this isn't about speed, this is about structure. And this is for investors who wants a clean, compliant, and supported entry into the Philippine market without over leveraging themselves. So now that you've seen both options, here's the real conversation. It's not about which loan is better. It's not about which strategy fits you, because there are two completely different approaches. A HELOC is about speed, leverage, and control. You're using your existing assets to move quickly and negotiate from strength. On the other side, OPHL is about structure, stability, and accessibility. It's designed to help you enter the market with the right framework in place. And here's the truth that most people don't talk about: people don't lose money because of the property, they lose money because they choose the wrong strategy for their situation. So before you even look at the details or at the deals, you need to get clear on these three things: your financial position, your risk tolerance, and your long-term goals. Because once that's clear, everything else becomes easier, smarter, and more aligned. So if you're serious about investing in the Philippines, please do not try to figure this out on your own, because there are multiple ways to structure this, and choosing the right one can make or break your investment. So that's why we're offering a complimentary strategy call. This is where we sit down with you, look at your full picture, and help you map out the best approach, whether that's leveraging your equity, going through international loans like OPHL, or even exploring completely different strategy based from your goals. Because this is, like I said, this is not a one size fits all. This is personalized, this is strategic. So if you're ready to make the move, we're ready to move forward, please schedule a call with us, and let's build this the right way from the very start. Now, risk checklist. Let's talk about something very serious investors needs to understand. Every investment has risks, and there's no such thing as a zero risk deal. The goal is not to avoid risk completely. The goal is to understand it, manage it, and control it. So let me give you a simple checklist you can always go back to. There are four main risks you need to be aware of. Currency risk. If you are earning in US dollars and investing in Philippine peso, exchange rates matter because your returns are not just based on property value, they're also affected by the currency movement. So you need to ask, if the peso strengthens or weakens, how does this impact my investment? Another risk is the developer risk. Who are you actually working with? Do they have a track record? Have they delivered projects before? Do they deliver on time and as promised? Because especially in pre-construction, you're not buying a finished asset, you're trusting execution. Another risk is legal. Is the ownership clear? Is the projects registered? Are all documents complete and compliant? If the legal side is weak, everything else becomes unstable. The fourth risk is liquidity. And this is one risk that many people overlook. If you needed to sell this property, could you? Is there a real market for it? Is there demand for future buyers? Your investment is not complete until you have a clear exit. So when you look at any opportunity, run through this checklist, not to scare yourself, but to protect yourself. And here's the most important principle I want you to remember. If you protect your downside, your upside takes care of itself. Because smart investors don't win by making or by taking the biggest risks. They win by avoiding unnecessary mistakes, making calculated decisions, and protecting their capital first. So, as you move forward, don't just ask, how much can I make? Instead, ask, what could go wrong? And am I protected? When you have that clarity, you don't just invest with hope, you invest with confidence, control, and peace of mind. All right, let's bring everything together. At this point, you don't just have information, you now have a framework. And this is where everything becomes simple once again. Because before you make any decision, make any investment decision, you don't need to overthink it. You don't need to guess. You just need to go back to the P.I.E.R model and ask yourself four clear questions. First, position. Is this the right location? Is there real demand here? Are people working here, moving here, choosing to live here? Because if position is weak, everything else becomes harder. Second, infrastructure. What's driving value here? Is it accessibility improving? Is mobility getting better? Is there real development happening around the area? Remember, infrastructure is what fuels growth over time. Third, entry strategy. Is this the right strategy for me? Does this match my capital, my timeline, my comfort level? Even a good opportunity can feel like a bad decision if it doesn't align with your situation. Fourth, regulation and risk. Is this safe and structured properly? Do I understand ownership? Is the documentation complete? Am I protected legally and financially? Remember, protecting your investment is just as important as growing it. Now, here's where it all comes together. If you can clearly answer all four, yes, the location makes sense. Yes, there is real value driven. Yes, the strategy fits me. And yes, it's structured properly. Then you know you're no longer guessing. You're making a smart, informed decision. And this is the difference. Most people look at opportunities and feel uncertain. But when you have a framework like this, you move with clarity. You know what to say yes to. And more importantly, you know what to say no to. Because at the end of the day, this is not about finding more deals, it's about making better decisions. And once you do that consistently, that's when real investing happens. And if you're thinking, I want I want to help anything this I want to apply this to my situation, and that's exactly what we're here for. Now, let me give you the rule that brings everything together, because having a framework is one thing, but knowing how to apply it with discipline, that's what makes the difference. So here's the rule we follow. If it fails even one part of the P.I.E.R model, it is a no. Not maybe, not let's see, maybe we'll make it work. It's a hard no. And I want you to really understand why that matters, because most investing mistakes don't happen because people don't know better. They happen because people ignored one red flag, justified one weakness, or made one emotional decision. They say things like, oh, it's okay, the location isn't perfect, the paperwork will probably be fine, the price is cheap, so maybe it's worth it. And that maybe is where problems begin. So what this rule does is it removes that gray area. It removes hesitation, it removes second guessing, it removes emotional decision making, and it replaces it with something much more powerful. It replaces it with clarity. Now, instead of asking, do I feel good about this? You're asking, does this meet my standards? And when your standards are clear, your decisions become easier. You're not distracted, you're not pressured, you're not chasing every opportunity. You become very selective. And that's where the real power is. Because smart investors don't win by saying yes more often, they win by saying no more strategically. So remember this: discipline is what protects your capital. And this rule, simple as it sounds, is one of the strongest ways to build that discipline. At the end of the day, you don't need more opportunities, you need better decisions. And this is how you make them. So, what we covered today is not just information, it's not just concepts, it's not just ideas, it's a framework, a way of thinking, a way of evaluating, a way of making decision. And that framework is, again, the P.I.E.R: position, infrastructure, entry strategy, and regulation risk. So I want you to really think about what gives you, if it gives you clarity, clarity on where to invest, clarity on what to actually buy, clarity on what to avoid. It gives you confidence. Now you're not guessing, you're not relying on opinions, you're not reacting to what other people are doing. You're making decisions based on a system. And more importantly, it gives you control over your decisions, control over your risks, control over your direction as an investor. Because without a framework, everything feels uncertain. But with the right framework, everything becomes intentional. You stop chasing deals, you stop second guessing, you stop feeling overwhelmed, and you start seeing opportunities clearly for what they are. So as you move forward from today, I want you to remember this. You don't need to know everything. You don't need to follow the right framework consistently, because success in real estate is not, it's not about one perfect decision. It's about making good decisions over and over again. And the P.I.E.R method gives you the ability to do just exactly that. And when you have clarity, confidence, and control, that's when investing becomes powerful, not just financially, but your future, your family, and your long term vision. So now the question becomes, all right, what do I do with all this? Because clarity is powerful, but only if you apply it, really. And that's because between, and that's a difference between understanding and actually moving forward. So, if what we talked about today gave you clarity, if it helped you see real estate differently, the next step is simple. You simply apply it. And that's exactly what we will help you do. This is what we do inside the Philippine Capital Shift. This is where we take everything you've learned today and go deeper. We bring real opportunities, real projects, real developers, and real data. So you're not just learning the framework, you're seeing how it applies in real life. And more importantly, you're able to connect directly with the people behind it. And for those who want something more personal, we offer the complimentary strategy sessions. This is where we sit down with you, look at your situation, your goals, your capital, your timeline, and we will help you apply the P.I.E.R model step by step to find the right path for you. Because the goal is not just to give you information. The goal is to help you make a clear, confident decision. So, if you're ready to take that next step, join us at the Philippine Capital Shift Summit or schedule a complimentary strategy call with us. And let's help you move forward with clarity, with confidence, and the right strategy. Because at the end of the day, you're not just making an investment, you're making a decision that impacts your future. And we're here to help you do that the right way. Before we close, I want to leave you with this. You worked so hard. You've sacrificed, you've made decisions, you've built something meaningful for your family, for yourself and your family. And that matters because not everyone gets to this point. So now the goal becomes very simple. Make what you've built truly work for you. Make it grow, make it multiply, make it support your future and your family moving forward. Because real estate, when done right, it's not just an investment, it's a tool for security, for freedom, for legacy, but only if done strategically. Because the best investors, they don't chase opportunities. They don't wait till everything is obvious. They don't follow the crowd. They position before the opportunity becomes obvious. And now you have the framework to do exactly that. You understand position, infrastructure, entry strategy, and regulation risk. You're no longer guessing, you're thinking like a strategic investor. Here's my invitation to you. If you're ready to take this to the next level, join us at the Philippine Capital Shift Summit. This is where everything comes together: real opportunities, real developers, real data, and real conversations. So, thank you so much for watching, and looking forward to seeing you in person soon. Have a great day.